So already Michał touched on the subject of automation of small business financing. And so this is one of the most common topics on fintech conferences: machine learning, artificial intelligence, automation. So this is one of those buzzwords that you hear all the time. Oh, it doesn't work? Oh, so. Okay. And what I want to do now is to step back a little and think, why do we actually need to automate everything? Because when you read the press, when you read the books, like the most common topic is that automation means headcount reduction, that jobs will be made obsolete, that soon there will be, all of us sitting here will be replaced by robots, and owners of the robots will take over the whole economy. And this is what you can read quite often. And I don't think it will happen in the next 30, 40 or 50 years. I think we are pretty safe, at least for now. And I want to say something super basic. The automation shouldn't be an objective in itself. The objective should be to create a tool that serves customers better, not to reduce costs, not only to follow regulations. There's this very famous Peter Drucker's quote: "The purpose of business is to create and keep the customer." And when we think, okay, how robots, machine learning, automation can create value, we should think from the perspective of customer. As for example, yesterday, Sonia Wederchowicz was discussing, and today on the workshop. And this can be a transformative value. And one of the examples which are the most striking is the decisions regarding prisoners. So there was a couple of, 2 years ago, there was a research which was, there was an experiment, observation of hundreds of different parole boards, how they make decisions regarding releasing prisoners early. So this is a huge decision, because keeping a prisoner in prison, this is like paying them monthly salary. People who stay longer, they're much less likely to get a job afterwards, so they're likely to commit crimes again. But on the other hand, if you release somebody who's dangerous, then they can kill, rob, or commit another crime again. So probably, if you think what should be the main factor that impacts such a decision, you would think, okay, maybe the length of the sentence, the crime they committed, the way they behaved. But the reality is the biggest factor was whether the decision makers ate their sandwiches. That was the number one factor. On this chart here, you can see that at the beginning of the day and after each meal break, 60% customers were getting an approval. But when when there were more decisions with time, they were less and less likely to make a positive decision for the prisoner. And ahead of the meal break, it was going down to 0. And how is it relevant? It's relevant because credit analysts make decisions exactly the same way. They are subject to psychological biases. Like this is called decision fatigue. This is one of the most common psychological biases, that the more decisions we make, the less energy for it we have, and we tend to keep the status quo. We think, okay, this guy is already in prison, let him stay there, it's easier this way. And the same is with credit analysts. They think, okay, why would I approve this guy? Maybe he will default and it will be all on me. And you have other biases like confirmation bias, that analysts see just the first decision and they already make up their mind, and they just look for other pieces of information which will confirm this decision. There's loss aversion, when people are afraid of making risky decisions, and they're usually more conservative than the management would like the analysts to be. So you would think, okay, this is no-brainer. We have to automate decisions. But when Moody's, a couple of months ago, in December, they made a survey among small and medium enterprise lenders globally, how much of the loan process is actually automated, the answer was in 50% of lenders globally, which were surveyed, there's no automation whatsoever. So what Michał is doing at SMIO is not actually very common. only 30% of SME lenders actually automate the decisions, which is ridiculous when you think how much money you're probably losing because of it. And when you look at analysis that McKinsey did, actually there's no other factor which has bigger impact on P&L of lending institution or lending business than automation of credit decisions. So this chart is showing 16 steps of a lending process, from creating a strategy, then lead generation, and then at the end with supporting the existing customers. And there's no other factor which has more than 10%, which doesn't have two-digit impact in percentage on all possible aspects of lending business. So not only you get much less losses, much less ops cost, because obviously you don't have credit analysts, but also you approve way more customers because people tend to be loss averse, and also many customers, when they have to wait for the decision, they back off. It can differ whether the customer is actually coming to the branch looking for a loan, then the drop-off probably will be lower. But when we are talking about an option, like pay by credit card or pay with a loan, then if it's not immediate, then 30–40% customers which will actually not take a loan if they have to wait for the decision. So this is a huge thing. So if you're a bank, if you're a lending company, but also if you're a trading platform that wants to introduce deferred payments, or if you're an accounting company that wants to introduce loans on their platform, you really have to have decision making completely automated.